Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This week sees the Bank of England kick off a new month with a pivot towards potentially lower interest rates. We have markets expecting to see a 25 basis points cut from the Bank of England following a period of elevated rates where they've been essentially flat, trying to drive down inflation. Well, headline inflation's at 2% now. So we're now starting to see the potential beginning of a new phase where we see interest rates being cut to the benefit of the UK economy and potentially to the benefit of UK stocks. So let's pick through the bones of it. Is it going to be a rate cut this time around? Are we going to see a number of rate cuts over the course of 2024? Where do things lay over the course of this year? And then how do they look at the end of next year? Plenty to pick through. Now, first and foremost, here's the view from Trade and Economics, pricing in a strong chance of a 25 basis points cut, with the vote shifting from just two members voting for a rate cut to instead a marginal majority of 5, with 4 abstaining or voting to see rates remain as they are. Now, here's the outlook in terms of inflation, and we have seen this disinflation pathway for many different parts of the UK inflation picture, but we have seen the services side of things really stagnate. You can see goods disinflation coming into play here with that blue line now below the 0 mark. So we can see it's all about services at the moment. And so whilst we do have that headline inflation rate at 2%, there's still a strong case to be answered that they have a significant amount of services inflation that needs to be taken out of the economy. Now, in terms of the breakdown for UK inflation, here's the headline number. Like I said, 2% currently the metric in play. But what we can see here is that there's a big 0.4 to 0.5 reading that's coming out at the next UK inflation reading, right? And you can see the last time around, we saw the monthly inflation figure of 0.111. So if we strip out this negative 0.4, I think it's around 0.4, 0.5 from the previous occasion, and we add in, for example, a 0.1, it's a good chance all of a sudden that 2% inflation rises towards mid 2%. It could be 2.4, could be 2.3, something like that. So suddenly you start seeing a reflation story. Now, it might not necessarily last all too long, because the next 2 months we've got some pretty healthy numbers that are stripped out, and then in October it might go back up again. But it's likely this 2% figure is going to be a bottom for the time being, with inflation moving towards the upside. Now, in terms of the core inflation, we can see it's at 3.52. So if we're looking for the Bank of England to cut interest rates, it's all coming down to that headline number, because core inflation nowhere near target. It's 3.5%. And where's the disinflation going to happen? You can see where the big chunky monthly prints are, and that's at the beginning of 2024, after January, because that's not going to be very useful, but February, March, April, May. So arguably 10 months from now, right? So it depends really how confident they are to just say, okay, well, on one side, we've got headline inflation at 2%. On the other side, we've got 3.5% on the core CPI figure, driven primarily by services inflation, which is going lower, but it is going like a very slow pace compared to the rate of decline seen elsewhere. So certainly it really comes down to what they're comfortable with. In terms of the wage pressures, underlying wage pressures, you can see here the yellow line earnings coming down, and it is on a downward trajectory, but slowly so, and very elevated. It's only just come through that 6% mark recently. So elevated wages. We have seen CPI decline, as you can see here, it's down to 2%. So we've got that differential between earnings and inflation, which essentially highlights real earnings, which is back up above that 0% threshold and continuing to rise. Now, that's good for the UK consumer. We saw the UK consumer in a position where the sky-high inflation was just outstripping their increased wages. And it brought about a position where the quality of living was deteriorating for people within the UK. That's now reversing. But it's worthwhile bearing in mind that if you're thinking about driving down inflation, and we can see 3.5% on core inflation, and you want that to be driven lower in the services sector, because that's pretty much where it is, because goods inflation is negative, The fact that we're seeing this upside, this growth in terms of real earnings, does point towards people likely continuing to spend, right? We're not seeing that same kind of squeeze on the UK pay packet as we did in the past. So really the Bank of England has to decide whether it's happy to just ignore that 3.5% inflation rate, which is going to take the best part of a year to come back down towards target. And even then, we may not get it towards target because we don't know what's going to happen in the meanwhile. And if we've got this surge in terms of real earnings coming at the same time that they're thinking they need to drive down services inflation, well, it could stick around. So the question mark is not only whether we see a rate cut this time around, it's how much confidence do they have that it will continue as we move forward, right? I mean, we're talking about the Federal Reserve and we're saying, oh, markets are pricing in a rate cut in September and then another two by the end of the year. So markets, when it comes to the US, pointing towards a trend of essentially a rate cut every meeting. Will the Bank of England be able to do that when they've got 3.5% core inflation and we've got this ongoing push towards the upside in terms of wages and real wages and services sector strength? Now, in terms of the expectations, like I said, it's near enough a coin toss, right? 58.8% chance of a rate cut this time around. But that leaves 41% chance of them keeping steady. Now, if you look further out, where would we be by year end? Well, markets are pricing in just 2 rate cuts by year end. So that stands in stark contrast to the likes of the Federal Reserve, where they're pointed towards 3 rate cuts within 3 meetings. This time around, the first rate cut is expected to come in August, and therefore 4 meetings by the end of the year, but just 2 rate cuts, rather than this Federal Reserve meeting, which by and large everyone thinks we're not going to see a rate cut, and then they've got 3 meetings they're expected to cut 3 times around. So that differential in terms of the pace of easing could become an interesting narrative as we go forward. If we've got one central bank that's cutting interest rates every other month, every other meeting, and one that's cutting every single meeting, then that creates a narrative that people would trade around, because it's going to create a different path in terms of downside for interest rates. Talking about the path, this is a Reuters poll pointing towards where some of the big banks and Citi and Wall Street analysts expect rates to be at different points in time. And essentially it's split out by quarter. So it's notable that if you look at, say, Q3, we're currently at 5.25, expectation that we get this rate cut and we get it back down to 5%. Then we're expecting to see it down around 4.75, so another 25 basis points by the end of the year. Like I said, 2 rate cuts by the end of the year. That's what markets are pricing. But then you can see by the end of 2025, it's around 3.5. So if you think we're currently at 5.25, the expectation is that we're at 3.5 by the end of next year. So that points towards some really serious rate cuts in 2025. And you can see exactly where that's happening. The expectation is that that big sort of gap, that big shift happens in the third quarter of 2025. Remember, I said it's going to take the best part of 10 months for us to see inflation back down to target when it comes to core inflation. And this really tallies up with that, right? It's going to take a fair bit of time for them to get into a position where they're cutting rates in a really consistent manner. And until then, there's a good chance that we're essentially going to see them taking a bit more of a tentative approach. So for this meeting, it's going to come down to a couple of things. But first and foremost, do they cut interest rates? If they do, then of course, the fact that we've got this market pricing, which is sitting on the fence, means that we will likely see a move one way or another, right? And that should likely mean upside in terms of UK related stocks, and that should mean potential weakness in terms of the pound. Then we're talking about the vote. So as I pointed to, we've got the trading economics, which is breaking down the 9 votes as being 5 in favor of a cut, 4 in favor of keeping rates steady. But we could potentially see 6 and 3. So that would be more convincing. That would point towards more members being willing to cut rates. And therefore, we can start thinking, well, in future meetings, they might want to cut rates at a faster pace. So again, that would be positive stocks and potentially weak for the pound. But then the flip side of it is, if you see weaker votes, then, it's the inverse of that. And then we look towards the commentary coming from the Bank of England and Andrew Bailey, and essentially say, what does the forward guidance look like? Do they point in the direction of a potential rate cut in September? Do they lay a pathway for the potential pace? Are they very cautious in their approach? Maybe they cut, but they don't necessarily outline a super dovish stance. It's almost like a hawkish cut. These kind of things have the potential to impact exactly how the market moves beyond just whether they cut rates or not, right? So these are the different elements that people should be looking out for. In terms of markets to watch out for here, first and foremost, I'm going to bring up the FTSE 100. Notable that we recently saw this breakout, and we're starting to pull back from that. But nonetheless, you can see here, right, the weekly time frame, we've got a lovely uptrend in play here. Just don't overlay the S&P 500, in which case you'll realize that probably is a bit more of a reliable performer towards the upside than the FTSE. Always a little bit slower when it comes to UK markets, but nonetheless, we've seen this breakout now. So what you can see here is this sharp move towards the upside. Then we come into this consolidation phase that looks to me like a 50% retracement. Yeah, so it's above 61.8. The 50% might actually be up there. That might be worthwhile putting on. There you go. Yeah. So all these points are respecting that 50% retracement. So we've come into a 50% retracement, tagged it time and time and time again. Now we've rallied up through resistance. That resistance came in the form of this 8314. Now we're pulling back, but the damage was done. We came into the support level. We've struggled to really gain any more downside momentum, and we've rallied up through resistance. So we're starting to pull back here. There's a good chance that this pullback is going to be a retracement phase. How long it plays out for, we don't know. It could be a short-term retracement, could retrace this wider move. But ultimately, for me, the fact that we've broken up through resistance, following that pullback within a bullish trend, I think there's a good chance that this pullback is short-term in nature. And certainly if we see the Bank of England coming out with a rate cut and we see them pointing towards potential further rate cuts in the future and relatively dovish assessment, it should help things along from the FTSE's perspective. Now, in terms of the pound, we have seen it gaining ground of late, and that's because of the fact that we've seen quite a significant repricing in terms of expectations for the US interest rates. So as we know, currencies are traded against other currencies. So you can't necessarily just say, okay, well, we think we're going to see a rate cut for the pound, and therefore I want to see, I want to trade the pound lower. Well, you have to trade the pound lower against another currency, and that's what makes it relatively difficult. Now, in terms of the daily time frame, we can see that we have seen a bit of a pullback of late. Now, whether this is just going to be a continuation of this recent trend remains to be seen. A lot of it's also going to come down to risk sentiment. Of course, the US dollar gains ground, and therefore cable loses ground when people are in risk off mode, and when they're feeling confident, then we are likely to see the pound moving towards the upside and the US dollar weakening. But for the time being, we can say that we're in a bullish near-term trend, and therefore the pullback that we're seeing at the moment is likely to be bought up until we see a breakthrough 1.26125. So the bulls remain in charge. We're yet to see any significant bullish reversal signal over the near term. A move through your near term swing high, which is 1.288, would give me greater confidence of that. But until that happens, this sort of bearish intraday trend does still remain in play. And certainly if we see rate cuts from the Bank of England and a dovish assessment, that could further the case for weakness for cable. But like I said, you also need to bear in mind what's happening over in the US. And we've got the Federal Reserve interest rate decision also this week as a precursor to the Bank of England decision. And so if we see the Fed essentially laying out their stall where people think that we're going to see 3 rate cuts this year, maybe we see weakness in terms of the pound, and therefore we see a rebound out of this near-term pullback. But it's all ifs, buts, and maybes. As it stands, we've got a near-term downtrend set within a wider uptrend. And so we're going to follow it on an intraday basis until we see a break out from this. Then we expect to see further downside. But until we see a breakthrough 1.2612, then we're aware of the fact that that near-term downtrend has the potential to rebound once again and push back up through that 1.30. So a busy week. It's very difficult as a trader to trade one particular event when you know that you've got all these other events. Bear in mind that we've also got a huge amount of earnings data coming out over the course of the week. 4 of the big Mag 7 names reporting. We've got the likes of the Bank of Japan, the likes of the Federal Reserve. We've got inflation coming out of the Eurozone and Australia. And then we've got the jobs report on Friday. So there's a lot going on, certainly. But from a UK perspective, it's definitely worthwhile paying attention to it, because this could be the first rate cut. And therefore, we want to know, how many rate cuts do we get beyond this? What's the pace of loosening when it comes to monetary policy going forward? And so this is going to be a meeting that really does set expectations for the markets.